Hello and welcome to Africa Business Weekly. I'm Akin Obakeye. Now, this episode promises to be intriguing as we dive into key discussions shaping the business landscape here in Africa. Let's get a sense of what to expect on the show today. In Southern Africa, Sim Tshabalala's retirement as the chief executive of Standard Bank is confirmed for 2027. As leadership transition plans are underway, we'll also look at the bank's half-year results. In East Africa, more monetary policy meetings made headlines as we see decisions taken on rate policies will focus on two countries and their growth plans. And in West, as Cote d'Ivoire gears up for its presidential election, how much shadow will this cast on the country's economic outlook? A packed show today, I must tell you, but let's get a sense of what's happening. Karabo now joins us for stories from the Southern African region.
Hello, Akin, and to you at home. Well, Standard Bank has reported that the chief executive, Sim Tshabalala, would retire by the end of 2027 as it reported higher half-year earnings that sent shares to an all-time high on Thursday. The bank reported headline earnings of 23.8 billion rand for the first half of 2025, up 8% from 22 billion rand a year earlier. And for more on the company's first half earnings and the looming leadership transition, CNBC Africa's Godfrey Mutizwa spoke to Standard Bank CEO Sim Tshabalala.
Decisions about one's life and chapters in one's life are always difficult, they're always complicated, they're always emotional. But they are easy decisions to make given the importance of planning and thinking ahead at Standard Bank. And as you saw in the press statement released by the Standard Bank Group Chairman, Ms. Nonkululeko Nyembezi, this is just part of the order of events at Standard Bank, preparing the organization for the future. And so the decision was made by the board for good reason to extend the retirement age. And then in my personal case, I cannot speak for Arno, but I know that he shares the sentiment. We have had a great innings. The cricket match with the rugby game is not over yet, I might just add. It's over, in my case, in December 2027, in Arno's case, September 2027, subject, of course, to what the board may decide to do to make sure that this is appropriately staggered. But yeah, not a difficult decision in that sense, just part of the order of life.
Yeah, so for many people, the question they were asking is, since the board decided that it was going to increase the retirement age for its executives, why didn't they do it for you and for Arno?
It would not be appropriate for me to answer that question. That's a decision that the board took in closed session. I haven't the foggiest idea, but it was the right decision, though.
You were ready to go, Sim, it sounds like. So let's talk about this half that you have reported, Sim. And as I was saying earlier, you are raising earnings to a record and the market responding and taking up the stock up today, I think close to 3%. The highlights for you?
Every single business unit was firing on all cylinders, notwithstanding a tough economic environment, resulting in headline earnings growth of 8% and earnings per share up 10%. And importantly, the most important metric, return on equity up 19.1%, thereby creating massive economic profits or shareholder value add for our shareholders. Corporate and investment banking saw huge growth in its loans and advances, particularly out of its investment banking division. That is reflected in our booklet. You saw corporate loan advances up 12%. Trading, as a result of our clients protecting themselves against interest rates, foreign exchange, commodities, and equity risks in this volatile environment, generating huge profits in a manner similar to what one has seen in other global markets businesses, whether it be Goldman Sachs, JP Morgan, and indeed banks like HSBC and Barclays. The next consideration is more of our clients doing more with us, particularly in the retail bank. Fees and commissions, resulting in fees and commissions being up in double digits, principally because, as I say, our clients are doing more with us through our channels, buying more of our products and our services. From a geographic point of view, South Africa was up about 2%, whereas the standout performer in this half from a geographic perspective was West Africa, in particular our business in Nigeria. The summary, therefore, Godfrey, is that you've got a portfolio of product, services, client segments, and countries that are generating that outcome of 8% up.
In more Southern African news, the 2025 Africa 50 conference took place in Maputo, Mozambique, and it brought together leaders and investors with one clear mission, and this is to accelerate Africa's growth by unlocking capital for roads, energy, and digital networks. CNBC Africa's Prudence Makubalo was in attendance, and there she spoke to Wamkele Mene, who is the Secretary General of the African Continental Free Trade Area. Let's listen in.
Africa 50, as you know, was established by the African Development Bank as a special purpose vehicle, specialized entity for investing in infrastructure in Africa. And after 8 years of establishment, I think we've all seen the results of what those infrastructure investments, deploying capital to infrastructure, we see the results. And so I think we celebrate today with Africa 50, but we also pose a challenge to the shareholders, and that is to make more money available to invest in trade supporting infrastructure. We have an interest as a trade secretariat, and the interest is to see efficient movement of goods across borders, efficient movement of persons across borders, trade corridors that connect the different regions of the African continent. That's our interest in all of this. And the investment that Africa 50 is positioned to deploy, I believe will enable us to significantly contribute to boosting intra-Africa trade. So this is a very significant event.
Let's talk about technology advancement. What's the impact in terms of technology, most especially when coming to reducing transactional costs upon the continent?
One of the biggest challenges that we face is the cost of trade and the cost of currency convertibility and the impact of that on trade. 42 currencies in Africa. If you are in Ghana, you want to trade with your counterparty in Kenya, before the AFCFTA, you would have to buy a third currency. We have now deployed technology to enable trade in local currency. So you can be in Ghana, you trade with somebody in Kenya, and you are trading in Ghanaian cedi and Kenyan shillings. Technology, and particularly financial technology, is a very, very important enabler of intra-Africa trade. And so through the Pan-African Payment and Settlement System, we've begun to address this very, very significant challenge. Second, again, talking about technology, enabling interoperability of our custom systems. That will require that we deploy technology, and we have begun that process of engaging in identifying the right technology to deploy to create a single platform for digitization of custom systems through the continent. All of this enabled by the Protocol on Digital Trade of the AFCFTA.
And just before I let you go, let's talk about the progress, most especially when coming to the initiatives of the AFCFTAs in terms of the PAPs as well as the adjustment fund.
Well, as I've just mentioned, the Pan-African Payment and Settlement System is live. There are over 126 commercial banks that have switched on to the platform. We have about 20 central banks that have also switched on to the platform. So we're making steady progress. The AFCFTA Adjustment Fund is also operational. We've just made our first disbursement of $10 million to a company that is focusing on intra-Africa trade.
From the south, this is where we draw the curtains for this week. But until next week, it's back to you, Akin.
Thanks there, Karabo. A beautiful evening to you, Tabitha. Now, what's cooking in East Africa?
Hello and good evening to our viewers. East Africa saw Uganda and Kenya hold their monetary policy meetings, with Uganda maintaining and Kenya revising down. Let's take a look at Kenya, where the governor added that the bank is exploring options to acquire gold as a reserve with a well-diversified economy.
Rates in the domestic market have continued to decline, while private sector credit growth has continued to improve, although the pace has been less than desirable. The committee therefore concluded that there was scope for a further easing of the monetary policy stance to augment the previous policy actions aimed at stimulating lending by banks to the private sector and supporting economic activity, while ensuring that inflationary expectations remained firmly anchored and that the exchange rate remained stable. With regard to the IMF, we do expect an IMF mission in September to start negotiations on a new program. We expect that program, when it goes to the board, will be discussed together with the Article 4 consultation discussions. Our preference will be to have a funded program, and that is what we have expressed to the IMF. On gold, yes, we are still analyzing the potential for us to acquire gold as a reserve to diversify our base of reserve assets. There are teams that are visiting the country just to go and see the potential for gold, but I think just to make a long story short, it is our intention to diversify our reserve position and to include some gold element.
While global biodiversity green bonds hit $1 trillion, Africa captures less than 2% of this market. So what's holding back private investment? I spoke with Bruno Moemba, UNDP's regional team leader for biodiversity finance, to unpack the challenges and opportunities.
Some of the key barriers that we're seeing is, one is the issue of pipeline, because financing by its nature is a demand and supply issue. So much as money on the supply side might be there, the issue around just having bankable, pipeline of biodiversity, friendly investments has been an issue, and that's something that as BioFin we are actually trying to, work around by developing these national biodiversity finance plans and also investment, pipelines. So that's one of the issues, but also just the risk, profile of most of the investment. We're actually bringing some clarity around the nature-related financial risks, so that the financial sector and private sector get to understand the nature of risks surrounding biodiversity-related investments and curating, potential de-risking, mechanisms around that. And therein also comes in just the issue around knowledge gap in terms of just the biodiversity asset class. I think it's still an unfamiliar, territory for quite a number of private sector and financials. And our role as BioFin is basically to bring in technical and financial support, support governments and private sector to, co-create investable projects around this.
And when we talk about matters finance, what are some of the financing mechanisms that we're seeing in place here, or rather instruments in place?
If you go on our, global website, you actually see close to about 150 different mechanisms that are available. But obviously at country level, we've got specific ones like, green bonds, payment for ecosystem services. We're seeing also, budget tagging, and also, quite a number of myriad other, even fintech now is actually coming into the biodiversity finance space. So even investment platforms, ecological fiscal transfers. So all these are a myriad of different instruments that we're actually seeing within the BioFin family.
And I'm keen on that green bond market there. It's rather interesting. So how do African green bond markets currently compare to global standards? And also, what are some of the maybe structural or even regulatory gaps that must be addressed to attract institutional investors at the same time?
Well, the global green bond market issuance, if you like, I think we got to about 1 trillion mark in 2023, and unfortunately, Africa still has less than 2% of that share. But some of the challenges are kind of, just the nascent ecosystem of the African capital markets, especially on the green side. We still have the regulatory issues, issuers, the verifiers. We're still building, capacity, but there's also issue of, incentives. And if you look at the Zambian context, which is one of the flagship, projects that we've done within the biofin, we began this journey almost 7 years ago at a time when the country was facing quite a lot of, constraints on the debt. And as such, we needed to look at catalyzing, private sector, working with the stakeholders like the Securities and Exchange Commission, developing green bond, guidelines, incentives. So it's been quite a collaborative effort with quite a number of financial sector and private sector players, including, fixing the knowledge gaps and the incentives that I talked about.
Mm-hmm. And I'm keen on data. Data is very important. Yeah. So to what extent are we seeing the lack of reliable biodiversity data and also transparent ESG reporting hindering investor confidence? And also in terms of challenges, how do we overcome some of these challenges?
Well, private sector, financial sector has traditionally, focused on two key issues for their investment decisions. Mm-hmm. And that's understanding what's in it for them in terms of the returns. But then beyond just the returns is what are the risks that are actually likely to affect, the attainment of those returns. But now with the emergence of impact, investors, we're also seeing that, impact data is one issue that's also, coming in. So part of the solution that we bring into the fore as biofin is basically embedded measurable indicators in the biodiversity finance plans that we are creating. And even at framework or institutional, framework, level, aligning with global, ESG norms, the biodiversity, global, framework, and making sure that national data, publicly accessible to build investor, confidence. So you actually not that part of our work on the risks. We have quite a number of countries where we're doing much more detailed studies around nature-related financial risks, so that we identify the dependencies and the impact of private sector on nature, and as well, what happens when nature, develops a fever, how that impacts private sector. So we've done quite some detailed, studies in Zambia, Mexico, and there's quite a number of countries where we're doing disclosure studies, Rwanda, South Africa, and many others within the biofin family. And this is all to tackle the question that you brought out on the biodiversity data and ESG reporting.
From fiscal policies to Africa's biodiversity financing instruments, the continent is navigating bold pathways to growth and sustainability. That's it from the region. Back to you.
And now to stories from West Africa. Now, with Cote d'Ivoire's economy expected to grow at an average pace of 6.5% in 2025, how much risks do the ongoing political tension pose to this growth? Robert Besseling, the CEO of Pangerix, joined us earlier for this discussion. Take a listen.
Over the next few weeks, we will see a steady increase in protests by youths in major Ivorian cities in the lead up to those October elections. And that's exactly what we have seen so far. We saw violent protests just this past weekend and also the previous weekend. And it is motivated really because, one, the political opposition has been excluded, and that has riled many of their supporters. Since then, also, President Alassane Ouattara, who remains widely respected, has declared his intention to run for a fourth consecutive term, which many people believe he should not be doing. And at the same time, it's also a socio-economic sentiment that is driving these protests. It's not just political. Many young Ivorians have simply been left out of the trickle-down effects. As you said, the economy is supposed to grow by 6.5% this year, one of the fastest growing economies in Africa, let alone the whole world. And yet, if you go to Abidjan, if you go to areas like Yopougon, where we have seen many of these protests happening, that's exactly where many youths have been left out. So this is not going to calm down over the next few weeks. In fact, at Pangaea Risk, we are advising our clients that over the next few months, we're likely to see an increase in intensity and frequency of these protests, which obviously can have a handbrake effect on that economic growth you mentioned, Kenneth.
Yeah, because this speaks quite a lot to the institutions of democracy within the country, and I'd love to get your assessment as well of that. And because we've seen that no Ivorian presidential election since 1995 has resulted in a peaceful handover of power, and I'd love to get your take on how these assessments are playing out.
That's a really great point, because this all comes down to the resilience of state institutions and democracy in Ivory Coast. President Alassane Ouattara, over his past almost 15 years in power, has been credited domestically and internationally by creating a more resilient state in terms of its institutions, in terms of its economy, in terms of its democratic foundations. And that is exactly what seems to be eroding at this stage. Over the past 15 years, since the last mini-civil war, Ivory Coast has become a resilient bulwark against the coup-prone Sahel and the Islamist militancy and insurgency that is gradually spreading southwards from the Gulf of Guinea. And just like places like Ghana and Liberia and other West African states, the state institutions in these countries is absolutely crucial to protect against that level of political instability and insurgency. That's why many businesses have invested in the Ivory Coast, and why to this day many development finance institutions, commercial banks, sovereign bond creditors still have a vote of confidence in Ivory Coast. But if these state institutions start to erode, as arguably they have already started to do, then it's certainly time to raise alarm bells on the Cote d'Ivoire.
Starting from next year, Nigeria will intensify tax enforcement efforts for resident and non-resident companies through the Nigerian Tax Act. Now, experts advise businesses to reassess the existing structures, related party transactions and business models to optimize their exposure to the evolving tax landscape. Now, Omobolanle Ajayi, manager transfer pricing services at Anderson, Nigeria, joined us to unpack these new tax laws. Take a listen.
The FIRS has always been trying to, expand the tax net, tax non-resident companies that do business in Nigeria. They've made some attempts in the past through the Significant Economic Presence Order, the Finance Act, but they've still not really been able to capture non-resident companies, either due to lack of clarity on some laws and not the provisions are not sufficient enough to even bring some of these entities into the net. But with this Nigerian Tax Act, there's an enlarged scope. A lot of activities are now covered and captured, and I think it would enable the FIRS effectively administer taxes.
Yeah, but how would you say the broader residency rules will impact outcomes here? Because we're talking about trying to get the foreign companies into the tax net.
Okay, so broader residency rules. It would impact it significantly. So I'll give some examples of some of the changes that have been made. Yeah. So for example, if non-resident companies in Nigeria, join JVs, with Nigerian entities or join partnerships, the income would automatically be taxed in Nigeria because the income was derived from Nigeria. There were instances in the past where non-resident companies may need to receive payments from resident entities in Nigeria. Some of those incomes may not have been taxed in the past, but now all payments received by Nigerian entities, except for a few exceptions like insurance premiums and payment for educational services, will be taxed. It will be covered under the Nigerian tax laws. In the past, if non-resident companies dispose of assets that are deemed to be chargeable, deemed to be resident, deemed to be in Nigeria, capital gains tax may or may not have applied. Now they apply. And amongst others, the scope of a Nigerian company has even been expanded. Yes, that has been expanded. Yeah. And fortunately, depending on how you look at it, foreign companies that may not have been captured may now actually be captured, particularly companies that their effective place of management and control is in Nigeria, even though they are not physically present in Nigeria, may now be captured.
For you then, what are some areas of concern, especially in line with this broader categorization here? Would there be regulatory clashes with other jurisdictions, or how do you see things unfold?
They may, but I would say that this is not a new push. Other jurisdictions are trying to broaden the tax net, are trying to ensure that companies pay the fair amount of tax. So what Nigeria is doing is not necessarily new. It largely aligns with the OECD two-pillar solution that was introduced sometime in 2021. It's just that Nigeria did not sign up to the two-pillar solution, but Nigeria is sort of taking a unilateral decision here to tax companies, non-resident companies that have significant economic presence, and trying to implement the global minimum tax rate unilaterally in this jurisdiction. So I would not say that it would be clashes as such. I would say it's not new.
Then would you say then that the scrapping of the 6-year audit limit, more or less is open-ended risk for taxpayers?
I would not say it was scrapped, right? Okay. I would say it was broadened, for lack of a better word. I would say it was broadened because it would not necessarily apply to all audits. I give an example. If a company receives a letter from the FIRS, I would speak from a transfer pricing point of view because I'm a transfer pricing expert. If a company receives a letter from the FIRS typically requesting for transfer pricing documentation or certain documents, right? In the past, if the FIRS doesn't get back to the company on time and some of those years become statute barred, and becomes arguable as to whether the FIRS can raise assessment for those years. But right now, the FIRS has, with the new Nigerian Tax Act, the FIRS can actually raise assessment for those years because if those the audit was initiated prior to those years becoming statute barred. So that's on the one hand. On the other hand, if the FIRS is able to establish deliberate misstatement in TP returns of certain clients or tax returns of certain taxpayers, then the FIRS can go as far back as it's sort of like open-ended.
And that's all we can take on this episode. You can catch all these stories and more on our website, and that's on cnbcafrica.com. Thank you for joining us today. Until next time, stay informed and stay ahead with Africa Business Weekly. I'm Aki Obakeye, and we'll see you again same time next week. Bye for now.